Welcome back to our channel. In this video, we'll break down how mutual funds are taxed and how tax treatment can change your real take-home returns. By the end of this video, you'll understand how tax impacts your net returns, how equity, debt, and hybrid funds are taxed differently, and how choosing between growth and IDCW options can change your overall tax bill. Understanding taxation is very important as it helps you estimate real returns, choose the right fund type, and plan investments more effectively so you're not surprised during exit time. Before we dive into this, we need to understand what are capital gains. They are simply the profit you make when you sell your investments above their original price. Here, the short term and long term rules differ by fund type, where equity oriented funds held for less than 12 months are classified as short term, while 12 months or more are classified as long term. And in case of debt funds bought after April 1st, 2023, gains are taxed at your slab rate. Now let's look at equity mutual funds. If you sell these within 12 months, that's short-term capital gains, taxed at 20%. Whereas if you hold for 12 months or more, long-term capital gains apply, where the first 1.25 lakh of gains each financial year are exempt and the rest are taxed at 12.5%. Example, you invest 5 lakh rupees in an equity fund and it grows to 7 lakh in 2 years. That's a gain of 2 lakh rupees. After a 1.25 lakh exemption, you pay tax at 12.5% on 75,000. That's 9,375 rupees. Your post-tax gain comes to 1,90,625. Now, let's look at debt mutual funds. If you purchase them after 1st April 2023, gains are taxed at your respective slab rate. But for older units held for 36 months or more, tax is calculated at 20% with indexation, while units held for less than 36 months are again taxed at your respective slab rate. Example, say you invest 6 lakh rupees in a debt fund and it grows to 8 lakh in 4 years. Assuming you fall under the 30% tax slab, you'll pay 60,000 rupees in tax and your post-tax gain will be 1,40,000. Now, hybrid funds are very interesting as they mix equity and debt. And in these funds, if equity allocation is 65% or more, equity tax rules apply. And if it's lesser than 65%, debt rules apply. Let's say you invest 2 lakh rupees in a balanced advantage fund with 70% equity allocation and it grows to 3.5 lakh. Your gain is 1.5 lakh, and as this fund has greater than 70% equity allocation, it will be treated as equity long-term capital gains, which means you will still get an exemption of 1.25 lakh and you will be taxed at 12.5% on the remaining 25,000, which will be 3,125. Thus, this makes your effective post-tax gain as 1,46,875. Now let's understand how growth and income distribution cum capital withdrawal options impact your tax outgo. Growth and IDCW are mutual fund options available to all investors. In the growth option, profits remain invested and you pay tax only on redemption. Whereas in IDCW, income is distributed at intervals and taxed every time you receive it. Let us take an example. Say there are two investors who invest 5 lakh rupees each in the same mutual fund scheme, but one chooses growth and the other chooses IDCW option. After 3 years, the value of growth option becomes 6.5 lakh and total value for IDCW will also become 6.5 lakh. But out of this, 75,000 rupees will be as IDCW payouts, making the current value 5.75 lakh rupees. These payouts are taxed at the 30% slab rate, which will be 22,500 rupees, while the growth investor pays only 3,125 as long-term capital gains tax. As we can see, growth can mean less total tax paid. Hence, the choice between the two becomes very important. What we have learned today is that tax directly affects your real returns. Rules differ for equity, debt, and hybrid funds. Longer holding periods improve tax efficiency, and your choice between growth and IDCW can significantly impact your tax outgo. Remember, tax rules can change, and your situation is unique. Thank you for watching. Don't forget to subscribe to our channel for more financial information and insight. Happy investing!